Good morning. This is Ken Long from Tortoise Capital Management with a review of the weekly report for June 18th, 2011. Happy Father's Day edition. We have a market that has moved back into sideways normal. It's on the verge of going into sideways volatile. On an annual basis, using Williams, using weekly RSI 14, we're at 47 out of 100, so below the 50-yard mark. On a 10-day basis, using the 10-day NDX, we're at 34 out of 100, so we're in neutral condition on both. Percent stretch above the 200-day moving average is at 1.70%, which puts us into sideways. It's rated as red because it's among the weakest readings of the past 6 months. The slope of the 50-day moving average has continued to decline and is now minus 0.42%, which is bearish and puts it in the red for the same reason. ADX is now above 25.2, so we can say this is a strong bearish trend developing. ATR percentage at 1.33% is on the high end of normal. Equities continue to sell off this week, increasing volatility back into sideways. The monthly rebalancing project is due to be reevaluated on 1 July, correction to that text, not 1 June. It's still holding IYR, EEM, and TLT in the 331. Quarterly and monthly rebalancing is going to be due on 1 July. ETF2, rather than no change, we're actually selling one position in XPI at the open. That will bring the model portfolio to 10%. Theoretical exposure in the model remains 0%. You can use this link to send me questions for the weekly webinar to consider. Looking at the health check, again, the vertical blue lines are 10, 20, 30-day look-back periods. The solid purple line at 137 is the previous swing high. The dotted purple line at about 134 and some change is current resistance and was the previous swing high. So that looks like a, head and shoulders has developed for those of you who believe in that pattern. The horizontal red line is the 5% pullback from 137. And the next red line is a 10% pullback from 137, and that represents the boundary of an official correction. If it crosses below the second red line, then we will be into a baby bear. Pullbacks between 0 and 5% from previous swing highs are generally classified as random noise, the market breathing. Between 5 and 10 are corrections in bull markets. And then below 10, we can start thinking about a baby bear developing. Solid green line is the 10-day moving average. Solid red line is the 50-day moving average. You can see how the slope has degraded from positive to negative, with the rollover point happening about 10 market days ago. Williams percent R10, we are oversold now for the last 10 days in a row, except for this little blip. I've added MACD histogram using 10, 20, and 8 to take a look at that indicator. You can see we're still below the signal line, doing a little better on as far as upticks go. And so if the 10% pullback area holds, we will have room to go. I've also added the slope of the 30-day regression line inside here for us to consider. You can see that it peaked at positive 0.1 right about the time of the swing high. So with price below the 10, which is below the 50, we are fractionally above the 200-day moving average. And that's a market that is in an aging bull, now actually bordering on sideways, and it's got to hold here and make a move back to the 50-day moving average for us to have any kind of belief that 137 is a reasonable target. Right now, the indication is to play good defense here and be ready for worse weather. Looking at a summary of the ETF2 regional report, you can see once more all are negative on a 5-week rate of return, which is why the theoretical model remains at 0% invested, 100% cash. SPY is fractionally better than EFA. And among the U.S. sectors, mid caps, then large caps, then small caps, then technology are the order of merit. The two strongest sectors among the 10 are U.S. mid caps and large caps, and the weakest are Latin America and emerging markets. All are under 50% now on the RSI weekly. Looking at the world market model, weakness in the U.S. except for large value and small growth. The commodities and other asset classes continue to dominate with the exception of oil. Japan is outperforming Asia less Japan. You can see the leaders remain Malaysia. Singapore and Hong Kong have given back, and Australia is starting to move up. India remains a reasonable play, having come a long way off its bottom. In Europe, generally stronger than the U.S. on the STR rating, and Switzerland and Germany remain at the top. Among the U.S. and then the global sectors, it's the defensive plays, staples, utilities, healthcare, continue to be the strongest relative strength. The 100 by 200 crossover system finds most everything safely in cash now, with a few exceptions in the defensive sectors. Healthcare, select, staples, gold, and pharmaceuticals. That's been a reasonable health check of the market by sector, if you will. ETF top 30, looking at consumer staples and healthcare, more healthcare, Swiss franc, gold, healthcare, precious metals, consumer staples, Australia, high yield corporates, pharmaceuticals. Malaysia is the first time that we see any equity penetration of the top 10. But you can see it with a further review, it's all defense. ETF liquidity, the top 30 by average daily dollar volume of the last 30 days. You can see silver and gold remain in the top 5 and 6, respectively. The volatility on silver's been cut in half compared to 2 weeks ago. Energy, the VIX, oil and gas continue to be reasonable intraday targets. Those that are highlighted in green, of course, are the ones that are exceptionally volatile intraday compared to the rest of the database. That's a quick review of the market. The weekend report. This is Ken Long. Keep your tortoise in front of you. Keep your risk measured and your powder dry. And we'll see you in the trading room.